billion in capital. We have effectively 15 companies in our growth and late stage book, and the remainder in our early stage book.
Hello, everybody, and welcome to this episode of Couchonomics with Arjun in collaboration with GFT in Japan. We're beaming in from Tokyo in Japan, where we're actually recording this podcast while in a shrine, which is quite unusual. We've never done that before. Joining me on the couch is Logan Allin. Logan is the managing partner of FinCapital.
Mm-hmm.
Have I got that correct?
Managing partner and founder, yes.
And founder, right?
Mm-hmm.
So Logan, with that, I usually say welcome to the couch, but since I don't have a couch here and I have a chair, welcome to the chair.
Thank you. Great to be here.
Excellent. So Logan, we've got about 25, 27 minutes, right? So it isn't, my usual sort of episodes are about an hour. So we'll have to be a little bit more efficient on time, which is a pity, but I'm sure that we can do a part two maybe later.
For sure.
I was kind of reading about you and your background, and there was this very interesting story, which is you were with SoFi Ventures, and I'm sure some people will want to know what SoFi is too, right?
Sure.
And then you sort of founded FinCapital, right? Talk us through this sort of transition. What was the thinking behind FinCapital? There's no shortage of venture capitalists, right?
Certainly.
What makes you guys different, unique?
Yeah, so SoFi is a neobank, and they still are very much focused on student lending. So student loans in the US is a huge problem. It was largely government driven before SoFi started in 2011. And then SoFi created a private market opportunity to finance student loans. And that was both origination, but predominantly refinancing of student loans. Turns out it's easier to underwrite people with jobs. And I went back to SoFi after having been there early days in 2017 to build out ventures and corporate development and help the company prepare to ultimately go public. And SoFi Ventures was born out of the view that SoFi had created this ecosystem, and there were a number of companies that were working with SoFi to power all the things that we did, which included and still includes banking, checking, wealth management, student lending, mortgages, the full array of services for a demographic we call Henrys. And Henrys are high earning, not rich yet. And so that is a great demographic to serve. And if you can create this really strong trusted relationship, obviously that will persist into the future. And so my thought in building SoFi Ventures was let's invest in the ecosystem we've created, and then let's go buy some things that will help our multiple as we go public, which turned out to be very B2B oriented. And so when I transitioned out of SoFi in 2018, it was really on the back of a management team transition. And I was looking at the market in 2017 and 2018 and realizing that nobody was going after what I affectionately call boring FinTech, which is B2B FinTech software sold into banks, asset and wealth managers, and insurers predominantly, although that's becoming also corporate oriented as well with some end users like Apple, for example. And so I started FinCapital with the view that that space was underserved, underloved. I also started it with the view that I wanted to build a firm built by operators for other operators. When I looked around the FinTech specialist ecosystem, or even some of the generalist VCs we had on our cap table at SoFi, they were all former investment bankers predominantly. And I very much wanted to help founders avoid the mistakes that I did. And work with them very hands-on, particularly on business development, helping them acquire customers, which is something that you can do repeatedly and adds a lot of value and keeps you in front and center and top of mind for CEOs. But also on corporate development, raising capital, helping them with M&A, helping them with IPO readiness ultimately. And then third, and certainly last but not least, is I wanted to create full lifecycle capital from pre-seed to pre-IPO.
All right.
And so we operate out of a venture capital fund and a growth equity late stage fund called Flagship and Horizons, respectively. And that full life cycle support for founders was also missing, in my view, in the market. So that's why I started FinCapital. And we've been on quite a journey since I founded the firm in June of 2018. And we're now at around 25 people across 5 offices, including one here in Tokyo, which we'll touch on more. And managing over $1 billion in AUM.
All right. And so your geographic spread is, well, you said 5. So I'm assuming you're in Japan. So I guess you cover pretty much the whole world.
We cover largely the whole world. I would say our focus, if you look at our portfolio today, it's 70-80% US. And then our international exposure historically been UK, Europe, Israel, LATAM, Canada. We opened up this Tokyo office and announced it on Tuesday with the view towards Japan and Singaporean headquartered companies. Principally because we think the end markets are tremendous from a customer perspective, meaning bringing companies into the region. But also we're seeing an inflection in founders building B2B fintech software in Japan and in Singapore, as well as a healthier and more mature private market ecosystem. And so that gave us a lot of confidence, having been traveling in the market for a number of years and studying the market and its inflection points, that we should officially set up shop. So we made Tokyo our Asia headquarters, and then we have 3 members of our team in Singapore as well.
Okay. And if I may ask, how much capital have you deployed? How many companies is within your portfolio?
So we have 125 companies in our portfolio, deployed around $1 billion in capital. And we have effectively 15 companies in our growth and late stage book, and the remainder in our early stage book. And we have a number of companies going public this year, which is exciting. And we're seeing a pickup in both IPO openness, but also in what I'll describe as animal spirits and M&A. So a lot of inbound from strategics and a significant amount of inbound from buyout players in this world of fintech software, because these businesses tend to be higher gross margin. They tend to have higher tech multiples. They tend to be pretty insulated from macro cycles. And we're in the midst of a long-term secular trend in adoption as it relates to particularly the banks. So the banks last year spent around $1.8 trillion on technology as an industry on their own. They are 1/3 of global IT spend on their own, and yet less than 8% of their data is in the cloud. And they spend almost half of that money on maintenance costs, which is just servicing legacy tech debt. And that is a scary, scary picture, which means they're going to have to dig out of that picture over the next several decades. And we think Gen AI is going to help with that picture, but certainly the fundamentals of fintech software in the front, middle, and back office are going to be massive catalysts.
So we share, I guess, if I may use the word, a common love. I've always loved the B2B infrastructure / software play. As a matter of fact, last year I wrote an article at just before Singapore FinTech Festival, which said FinTech is dead, long live FinTech, which was largely my view that FinTech has moved from purely being a B2C play with guys and girls wearing torn jeans to
certainly
slightly more serious players. And I think one of the big shifts that we're starting to see slowly, but at least we're seeing, is that banks are realizing that they just cannot transform now within themselves, and FinTech becomes part of their infrastructure play going forward. I guess you're incredibly well placed for that. I'm gonna request you to sort of kind of go to a higher level of abstraction, just talking about FinTech, right? And just financial services generally, right? Talk about a few trends which worry you rather than actually trends that, we consultants love writing reports. There's one, I guess, every minute of the day these days.
Certainly.
What worries you in terms of how FinTech is evolving, either from a regulatory perspective? I think a lot of the stuff around cloud you mentioned is also because data residency is data is becoming like a national property. But let me not give the answer. I want to hear your views. What concerns you in terms of how the financial services sector is evolving?
I think in terms of the biggest risk within financial services, and then maybe what worries me in fintech in particular. So the biggest risk in financial services right now is banking core infrastructure. That is the number one target for US regulators in terms of what keeps them up at night. It's what keeps me up at night. And that very specifically is very simply the general ledger of the bank, right? So the banking cores in the US, you really only have 3 primary players. They haven't changed in decades. That's FIS, Fiserv, and Jack Henry. Whenever there's been a new upstart, there was a company called Finxact, for example, that was a cloud native core banking system that was trying to solve a lot of these issues I'll speak to. Fiserv bought it and effectively integrated it, but largely shut it down. And that's a real concern in the sense that they are incentivized to keep the patient sick. And the banks are sitting on crumbling foundations in the form of those core banking systems. And they need to do one of two things. Either they need to rip and replace that. Challenge is not a lot of options out there in the market. You actually have more options in Europe with players like Thought Machine and Mambu and Tomb. And Tomb in particular has entered the Middle East. But in the US, we have no good solutions. And so that rip and replace option is actually not a real option right now for US banks. And by the way, this applies to global banks as well. And, they look around and either they're sitting on a legacy Hogan software, one of those three players, or something that's homegrown that nobody knows how to solve for at this point. And so we think core banking systems and back office is sexy again and needs to be. And we hope that founders are working on those very hard problems because that is the number one thing that keeps me up at night. I would say the other option they have is to band-aid it, which is what they've been doing. This is where banking as a service, or BaaS, came out of. Banking middleware has evolved out of. And there's definitely solutions out there. I sit on one board that I'll plug called Synctera, and they are trying to solve and be that band-aided middleware to create a more modern API layer that supports integration with modern fintechs in the front and middle office to solve for things like front office technologies, underwriting systems, credit card issuing systems, compliance, and so forth. That's great, but it only solves for it for so long. If you ever go to your bank's website at 10 o'clock on a Saturday, you're going to see it's down for maintenance. And this speaks directly to that problem, and it's a global one. And many of the most global banks, one of the banks that I met with recently, the CTO, and he asked me how many bank core systems I thought he had around the world, around this global bank. I said a dozen. That seemed like a logical guess. He told me 55. So 55 core banking systems to support one global bank. And that's because they've grown through acquisition, they've grown organically, they've grown cross-border, and there's really no core banking systems that scale on a global basis. And so that's a huge problem. That's like my biggest fear in the industry right now in terms of infrastructure, in terms of potentially systemic risk. In terms of what's concerning about fintech, I think you still have, to your earlier comments, direct to consumer, direct to small business, and crypto founders trying to move fast and break things. And we underwrite to repeat founders and or very seasoned entrepreneurs. The average age of our CEOs is 43. Mm-hmm. So these are not 20-somethings that are trying to move fast and break things. And we're still seeing a lot of that. And to your point, they realize direct to consumer, direct to small business in crypto is really, really hard and very binary and probably underloved by VCs at this point, which is accurate. And they're pivoting and they're trying to launch B2B software solutions that are institutional grade that are, I think, going to be very problematic. And so that does keep me up at night. That speaks to kind of regulatory oversight. It speaks to VCs providing checks and balances around those types of businesses. And it certainly speaks to bank, asset and wealth manager, and insurer procurement and diligence processes that need to be, very rigorous as a result.
Very interesting. Just to share my sort of 2 cents worth on this, I totally agree. Core banking infrastructure, core infrastructure generally is a big challenge. One trend that we are seeing, and I don't think that's very different to the Band-Aid, but I don't think it's a Band-Aid, is we're starting to see some dual core, parallel core creations, right? Where it's like a old bank, new bank,
right?
And banks want to do this transition because I guess the big bank approach, where an average tenure of a CEO is 3 to 5 years,
right?
It doesn't correlate well. You don't want to be the CEO who put everybody through 3 years of pain.
That's right. Yeah, on a 10-year project.
Right. Exactly. Yeah. Right. And started that 3 years. So I do think, and I do agree that I think we're starting to see a quality of players emerging, who are cloud native, API first. But there is a little bit of naivety that I'm also seeing with these guys that I think they are. They've had too much of their own Kool-Aid. And I'm sure VCs, or if I say, VCs who have seen the movie,
Yep.
right?
Mm-hmm.
Like you,
Mm-hmm.
I hope you're tempering that enthusiasm,
Mm-hmm.
that sort of Kool-Aid by saying, guys, you don't have to be so in love with what you've created that
Mm-hmm.
everything is wrong.
Right.
Because fact of the matter is banking's lost a
Mm-hmm.
century, and some of these systems at least 20 to 30 years old.
Certainly.
And I think there's a transition. So I guess that was my little sort of comment. And because there are a couple of very interesting infrastructure players
Mm-hmm.
in the core banking space, which have actually come out of India,
Mm-hmm.
and they've gained traction. Let's talk about Japan. I'm assuming Japan has similar problems.
Mm-hmm.
Actually,
Mm-hmm.
I would say bigger, right?
Agreed.
My observation of Japan, and I don't know this market really well, it's my
Mm-hmm.
third trip here, but I've actually now started to meet some of the banks, is they're incredibly comfortable
Mm-hmm.
in where they are.
Mm-hmm.
They have these cozy relationships with the big techs, the
Mm-hmm.
local big techs
Mm-hmm.
out here, and they don't really see the need. Right.
So it's interesting. I would have said that was accurate when I came here, 2 to 4 years ago in that time frame. But it's changing. It's evolving. So I'm going to give the mega banks some credit. You've seen this from SMBC, MUFG, Mizuho. They've all leaned into digitization and they've created mobile wallets and certainly fintech partnerships. And so we're actually seeing more of a positive reaction to digitization and embracing third-party software. Why? Gen AI. Gen AI came in and they said, whoa, we cannot build this ourselves.
Exactly.
And that was this aha moment. I would also say COVID contributed to that, right? COVID comes about and you can't send people to bank branches. You can't send people in the call centers and you can't get your tech team together for an on-prem development effort, right? And so interestingly, Gartner, shows this data pretty clearly where pre-COVID, roughly 10% of global bank spend was on third-party software. And now that number is over 30, right? So there was this massive adoption acceleration as a result of COVID. And obviously cloud adoption has still not happened. And that lift and shift problem to the cloud persists. But Gen AI is actually creating solutions for that lift and shift problem. We have a company called Mechanical Orchard that's focused on that exact problem, using Gen AI to replicate applications in a private cloud scenario in real time, so that you can decommission that legacy tech debt and that code base or that mainframe technology. And so I think the banks now, as a result of COVID, result of Gen AI, are recognizing they need to partner with third-party software providers. And there's really two types of third-party software providers if we put it in the Japan context. There's the global winners, right? So if you go to a bank and you ask them what CRM they're using, they're going to probably say Salesforce, right? There isn't some bank CRM that's better than Salesforce out there. If you ask them what ERP package they're using, they're probably going to say SAP or Oracle. There isn't, some fintech specific player in that regard. But there are, in our view, in our mind, going to be category winners here in Japan. And that's going to be both for direct to consumer, which we've already certainly seen with PayPay and Paydi and others. There's going to be category winners in direct to SMB, which certainly we're seeing some of as well. And there's going to be in this category B2B software. Those things actually grow and persist in order. In every geography, if you look at the history of fintech, and we have mapped this and we have slides on this if you're ever in need of bedtime reading. Every country starts with direct to consumer because, hey, the bank's mobile software and the experience is terrible. Let's go build a competitor. That was certainly our intention at SoFi. We wanted to beat the banks. Then they recognize, oh man, merchants and SMBs are also underserved by the banks, particularly on credit and deposits, and the onboarding experience is all terrible. Well, then Square Block comes about, right, in the US, or SumUp in Europe. And then third, the banks wake up and they say, wow, we're actually seeing fintechs nipping at our heels. We need to get with the program. And there's never been a moment in time vis-a-vis COVID and Gen AI where that process is accelerated so dramatically. And they're getting very serious about pointing capital at the problem. You're seeing that with JP Morgan, who's spending circa $25 billion per year now on technology. And so, from our perspective, the Japanese banks are now leaning in, as are the asset and wealth managers. And the insurers very meaningfully. And then I think you're also going to see that from the corporates as it relates to Rakuten and Line and others who are, trying to create these super app type solutions where fintech and payments in particular is clearly a nexus. So that's on the Japanese bank side. And then happy to talk about Japanese entrepreneurs and founders and what we're seeing just particularly from the startup ecosystem.
No, happy to hear that
Yeah.
because I'm assuming establishing Japan is a two-pronged strategy at the very least. One is to actually bring your portfolio of companies out here,
Yep.
right? It could be a three-pronged strategy in terms of raising some of the, having some of the LPs from the local market,
Correct.
but also actually putting some of that capital into the local
That's right.
entrepreneurship market. What are you seeing there specifically?
Yeah, so exactly right. So we're here to bring companies into the region, which we've been doing successfully with no people on the ground. And we've got roughly 15 companies that have operations now in Tokyo and have done it remotely. And so now with a team on the ground here in Tokyo, we'll be able to affect that, we think, more directly. Two is, to your comment, investing in Japanese and Singaporean headquartered companies, but with Tokyo as our Asia headquarters. And then three is engaging with Japanese LPs, where we're seeing more appetite and interest in private markets, particularly with support from Japanese pensions and the Japanese government, which we think is a huge positive. I think on the second aspect, in terms of what we're seeing from Japanese founders, is that I think founders here have developed a reputation that they just want to stay in this market, they want to build in this market, and they want to exit as quickly as possible in this market. We have seen certainly a little bit of that, but I think this FinTech festival and the conference here is a testament to the fact that that's changing, that Japanese entrepreneurs want to take bigger swings and work on harder problems and build companies into the future and have larger exits that are actually impactful, both from a wealth creation perspective, but also an impact on the industry standpoint. And you're seeing that in the data. So last year, there was about 18 billion deployed into venture capital here in Japan. And that was a 40% increase year over year. That's a big increase. As part of that, though, 45% of that came from foreign investors. But 85% of it was CVC and corporate dollars. So we need more financial investors who are going to then work with those founders to drive those types of outcomes and create that type of alignment. And then I think the Tokyo Stock Exchange, to their credit, I spoke there on Tuesday, is very cognizant of this problem of, hey, we're going to go public at a $100 million valuation and de minimis revenue. That's not a sustainable public equity market. They have 4,000 companies on the TSE right now. That is a lot of companies who are smaller and potentially not sustainable. And I think the founders still look at that TSE listing as an exit versus a launching point, or a continuation or a growth opportunity to raise further capital and continue to build. And so those aspects do need to evolve, do need to change. Part of that is going to be regulation and supporting the things obviously we've implemented around the world, such as how you treat private market stock, creating incentives around that. We call that QSBS in the US, and 83B elections and so forth that incentivize entrepreneurs to build and put sweat equity into companies, but also incentivize investors vis-a-vis how those things are taxed and aligned. And then they need to look at building outside of Japan. And the way we think that gets accomplished is through what I referenced earlier, which is just business development and customers. So I kind of jokingly described this the other day to somebody as pulling them by the hair out of the country, meaning giving them customers in Singapore, in Malaysia, in India, and allowing them to expand through the comfort and safety of a customer or a lighthouse relationship that they can build with. And so we think that's incredibly important, is to have a BD operating value mindset. And if you're a corporate versus a financial investor, you actually want to retain that technology for yourself. You have no incentive to introduce that company to others as a CVC, versus as a financial, we want to be Switzerland. We want to introduce them to all the customers.
Totally.
And so we think that's a key aspect. And then the last thing I'll mention that we think is important, and we've spoken to the Japanese government and others about this on the regulatory side, is if you're going to encourage in that first category of what we're focused on, bringing companies into the region, it can't be pure, I love sales guys, but it can't be pure sales guys. This can't be rep offices. These actually need to be product and engineering talent. And in terms of the soft landing approach that you can utilize to incentivize that behavior, there's absolutely tax credits, there's absolutely financial support and soft landing apparatus that the Tokyo metropolitan government has put in place, for example, to incentivize that type of talent to come here. And we think that creates more of the flywheel effect that you need in the ecosystem for Japan to continue to thrive as it relates to technology and innovation, particularly in fintech.
No, it's interesting. I had Jordan from Antler X yesterday, and I think a lot of what he said was very complimentary of you. Here's my last question to you, Logan. So while VC gets a lot of the credit and a lot of the limelight, there's a lot of, I guess, negativity which gets thrown around, right? And we have a friend in common in the Middle East, and he often tells me that I tend to sort of bring VCs on the show to actually tell them that they know nothing about fintech, which is not entirely true. But that is true about a lot of VCs, specifically in the fintech or generally the tech space, that their appreciation of the technology or the sector, and sometimes even the business model doesn't exist.
Agreed.
Right? So 3-pronged questions, right? So how have you seen the maturation in terms of the VC community? And you can answer this question from a global perspective or from the way you are, because you're unique, right? You're unique in the sense that you worked in industry, then came to an industry, came into VC, but go to the industry you're in. 3 things I've observed. One is VCs sort of lacked the knowledge of what they were spending money on or investing money on. Secondly, most of them, woke up 2 or 3 years ago writing charters on how to be a good founder. And my logic was, why wasn't that the case 5 years ago? Because everything they wrote 2 years ago were valid 5 or 7 years ago when they were being discouraged. And thirdly, have you actually, seen a change in the attitude from the LPs, right, towards the VCs? So generally, just the question is, how have you seen the VC market mature?
Certainly. So thankfully, I think post 2020, 2021, where there was a lot of dumb money in the market and tourist investors who had no business writing checks into Series A's and doing venture capital, as crossover investors who were underwriting in many cases on forward-looking data on a multiple that didn't make sense. So there was a lot of tourist investors. Those have been cleared out, and obviously we think that is terrific because we're now seeing a return to fundamentals on how underwriting is done, what multiples are applied, and certainly we're out of the ZERP era of free capital and hopefully bad decisions, unless you're talking about AI, which there's still a lot of bad decisions being made in that world. So I would say fundamentals are there, except in AI, and AI has become incredibly bubbly and challenging and problematic. And I think there's going to be a lot of consolidation and fallout in AI. And there's a number of large, particularly proprietary LLM companies that we would be short on. I think that was a hand on the stove moment for the VCs, and some woke up, some did not, and are still just repeating those mistakes. But in the next cool thing, the prior cool thing that they blew up on was crypto, obviously, with FTX and all the capital that was put into that business and others similar to it, which had no business receiving capital because you had a set of first-time founders who did not have any governance or any institutional capability and no experience. I wouldn't have trusted them to run a lemonade stand. And so I think for us, VC has evolved. We continue to see kind of cyclicality in how VCs have been disciplined or not. Our view in talking to LPs is that we've just stuck to our knitting, so to speak, and stayed on one playing field. And that is backing repeat and seasoned founders building fintech software, looking at specific metrics by stage and holding those companies accountable to those metrics, ensuring that we can get the proper level of ownership, which for us is 10% or more, with the right governance. And last, but certainly not least, is having the right to win and having the right to add value. And if you are passive capital in VC, you are dead capital. And for us, we need to be able to add value and look ourselves in the mirror every morning to say we are helping this founder every single day as a proverbial Sherpa for the business. And if we're not, then we really don't deserve to be in that business, nor should we have written the check. So that's how I think about it. VCs do and should get a bad rap if they're passive capital and they're not adding value and they don't understand the space. To your comment, generalist VCs who invest in FinTech maybe have 1 to 2 people that look after FinTech for them at the partner level. We have 25 going to 30 this year, and this is an incredibly difficult industry. And you have to be able to add value, underwrite, manage the portfolio, serve on boards, but you have to do it from the perspective of domain expertise. If you don't have the domain expertise, you shouldn't be investing in FinTech because you're going to make a ton of mistakes. And I don't believe in, pattern recognition or simply backing the quote unquote best founders. I think the best founders who work with us appreciate that we understand the domain, we understand the pain points, we understand the regulation. And that's, why they want to continue to work with us. So I'm very proud to say we've had 6 founders now exit, earn out, and then start all over again working with us. And so I want that number to be 100 plus in the coming years. And obviously we feel like there's a lot more to do in this element of FinTech infrastructure and software. And we're excited to see what founders are building next and how we can help them on that journey.
Excellent. Logan, thanks for coming in. Pleasure. It was actually educational. And I thoroughly enjoy talking to venture capitalists. I guess I'm a closet venture capitalist. I've been angel investing for the last 10 years.
You're a VC, absolutely.
Well, I don't know if I'm a VC yet, but I've put some good money. That's
great.
Where my mouth is.
Personal capital is true risk capital.
It's true risk capital. I totally agree with you.
Yeah.
It's my daughter's next handbag, as I put it, right? But she's on a holiday with me, so she'll definitely get a handbag this time.
Understood.
But no, thanks for coming in. And if you're ever in the Middle East, do give us a
love
call.
Dubai, love Abu Dhabi, and we'll let you know when I'm there next time. We'll go hang out with the Venture Soup team.
Love to do that.
Excellent.
To do that, right?
Thank you, Arjun.
So, ladies and gentlemen, that was Logan Allin from FinCapital. This was an interesting conversation and a refreshing one because unlike a lot of other VCs I've had a chance on the show, he knows his stuff. So with that, I'll say goodbye to you till the next episode. Bye.